Hello, everyone.
Good morning, sir.
Good morning. Good morning. So, did you go through the material which was sent to you yesterday? At least some of you. I posted something related to a small caselet and also one small article. So, could you go through it or you're not yet seen it?
No, sir, I has seen a bit. I've gone through the sum. I've solved a bit.
Okay, great. That's good to know. Okay, so of course, I'm not expecting that you will get all the entire answer because I sent one more version of the same material. So you can actually cross check your answers with that also. If you have downloaded the earlier version, then probably you had to even forecast.
So I wanted to ask you something. Hello, sir.
Yeah.
Sir, the forecasting, the assumptions that you had given in the Excel sheet,
Uh,
are those assumptions the same for every company?
no, no, not at all.
So, sir,
And yes, go ahead.
the other day I asked you about taking assumption like I thought of taking inventory as a percentage of COGS. So you asked
Correct.
me to check the past trends.
Correct.
So, sir, I could not really understand how would I do that.
See, trend analysis is fitting the regression line.
Okay.
Okay, so there are models in, I mean, you can develop the model using either Excel sheet or any other program, okay, which you are
Okay.
comfortable with, and you can get the estimates of the future. So those are available if you have some kind of software where you can do it, or else we can do it in R or even in Excel. Okay, so the thing which I have shared with you is Excel only, and the forecasting figures are given to you there. But in real world, you have to find those rates, and that is going to be challenging in terms of taking how many years data and whether that is going to represent future or not. So those questions will be there, but normally what we say is, okay, the last 5 years at least we should see what is happening, and then we can take that as the percentage. But if you do not get a trend during that period, or you find something odd which is not representative of the company's performance, then you should not take that particular figure because, for example, in your case there was negative COGS.
So
If
actually, I checked that
yeah.
with the reports.
Hmm.
So what the portal from where we downloaded EMIS that
Hmm.
has correct data and that has incomplete data as well. So when I checked the annual reports of all these years that I
Hmm.
had downloaded on,
Hmm.
I realized that all the expenses were given with that minus sign.
Okay.
It didn't mean that
Correct.
COGS was
So
negative.
maybe I think you read it wrong then in that case.
Yes, sir.
That's
The
what. Yeah.
portal gave the.
Okay. So there will be small issues like so. I'm happy to know that you people are going through that because at least when you go through that, you will at least realize that okay, there are so many issues which come up, which are not covered specifically one by one in the class. But only when you go through that, then you will come up with some
Sir, I
doubts. And
think
then
your
we'll
voice
discuss.
is breaking, sir.
Yes, Nikhil.
Hello.
Hello. Yeah, tell me, Nikhil. Go ahead, Nikhil. Okay. I think
Sir, I think your voice is breaking.
my voice is breaking. Okay, 1 minute. Hold on. Hello. Yeah, can you hear me now?
Yes, sir.
Yes, sir. Yes, sir.
Okay, okay, all right. I think there was some internet issue. Maybe sometimes the network goes off in between and all that. Okay, so if you can hear me, we can start unless you have any other questions. Please remember that when you are doing the project, which I'm assuming that you are doing the project, you will face certain difficulties and you must come up with those questions. Don't delay it further, because now onwards, what, as I shared the Excel sheet, we'll be actually doing many other works like that, and we have to do parallel work, and that too on your company. So even if you have taken the companies of your choice, which you already know, the calculations would be quite different. So it doesn't matter whether you know the company earlier or not, because we are not going to do what we did on that company previously. So we have to do something entirely new, and this requires a lot of uh, calculations and understanding those particularly, right? So as particularly we discussed about what is net operating working capital in our calculation of free cash flow. So we need to look at what those terms mean, whether should we include or not, and all that. Okay, so there are practical issues which project will divulge, and the other issues theoretical we can definitely work out in the classroom, and then the examples which we take there, everything will be given to you, right? So for example, some rates are given to you, WCC is given to you, growth rates are given to you, right? Then you have been given that FCF1, FCF2, FCF3, all these are given to you. But when you go to the project, you will find that all of that is not available to you directly. Either you have to search it from the internet to say that whether somebody has done the calculation, or the best way is to do it your own calculation, because when you do your own calculation, you see that there are various challenges and how to deal with those challenges, because that will open up a lot of conceptual debates, and then that is where the learning will happen. So if you want to learn, I would suggest that you should go through all those projects, because projects actually throw challenges at you, and that's how you will learn. So take projects seriously. I'm assuming that you have downloaded the data, and you have started doing the FCF calculation. And please remember, as we progress, you will find that you will have to change your calculation also slowly, because it depends upon what we learn, and then accordingly you can do it. Okay, more or less what we did so far, I'm just going to cover. So I wish that all of you participate now. Okay. So can you tell me what is that actually we were doing last class? I remember that we were talking about trying to do the adjusted present value, right? And therefore I was giving you the background of adjusted present value, if you remember. Yeah. Tell me, what do you remember? Yes? Anybody? Do you remember that? Anybody remembers what we did last class? Hello, can you hear me?
Yes, sir. We can hear you.
Okay, so there is a gap, so probably don't remember.
Yes, sir.
Okay, nevertheless. But I think you should keep track of whatever is happening. So let's begin with the.
Value added, so we are focusing on formula of market value added.
Come again?
Market value added formula, sir.
Oh, that was long back. I think we talked about the market value added when we talked about the FCF example, where we talked about calculation of ROIC, right? Market value added, economic value added, and those formulas were there. That was the first setup example which we did, and from there we moved on to look at application of these formulas. So I'm going to write that formula once again, which is a single formula which we have been doing from the beginning. So let me write that, and that equation is this equation, which you already know, right? So you can actually look at what I do here. Like, we know that the value of the operations, which we wrote like this. So now you can see that there are some subscripts will come, and the things will change. So we said that it is the summation of FCFs, okay, divided by 1 plus WACC. Okay. So this we will be writing throughout the class so many times that so T is equal to 1 to infinity. Okay. This can be broken as we saw in two terms also, that I can write this as FCF T 1 plus WACC raised to T, and T is equal to 1 to some period, that is capital N, let's say, and remaining is the remaining period, right? Remaining period after n year. Suppose if n is 5, so sixth year onwards we need to calculate the FCFs. So the same thing can be actually written like this. The same thing remaining, that I'm saying that T is equal to n plus 1 to infinity FCF T divided by 1 plus WACC raised to T. Now understand why we are breaking this, and we discuss the logic behind breaking this particular formula. So this is the entire period. So let me suppose I want to draw a timeline. So what I am looking at is this formula is saying that from 0th period to second period to all this, and it goes into perpetuity. So this formula is from 0 to infinity, right? So you understand this one, right? Now we are going to look at this part. So this part is like this. So 1, 2, 3, 4, 5. And we are calculating FCF1 separately, FCF2. Like that we'll calculate FCF5, right? This is the 0th period. And then this plus, that is this part now. This part. This is talking about from the 6th year to infinity period. So there will be FCF6 and so on, and it will go on. Now that means we have broken the bigger period into two parts. One, this part is for forecasting. Please stop me if you don't understand some part of it, okay? So that is important that we participate and understand it properly. Okay. So what we have done is total period has been divided into two parts. First part is the forecasting part, and then second one is perpetuity part, because from 6th year onwards we are saying that it is going to be perpetuity case. For the value of this particular thing, we are saying that it is at the point when we calculate the value of these 6 years, it will be called terminal value. But now let's look at from first part, which is the forecasting part. So we calculate the present value of FCF1, present value of FCF2, and likewise for all the periods up to FCF5, right? This is what we will do for individually the forecasting period, the period for which you did the forecasting. Now, from the 6th year onwards, we have got a perpetuity case. So for which, when we calculate the value of this using the perpetuity formula, we get the value at the end of 5th year, and that value will be called as terminal value or continuing value, right? So when we say that the terminal value, what we are saying is at the period of termination of the forecasting period. So the terminal value is nothing but end of the forecasting period. At the end of the forecasting period, what is the value of remaining period? That is what we are saying. So the remaining period which is there after forecasting period, that is from 6th year onwards, whatever is the value of those cash flows, right? Here at the end of 5th year, because when we do the time value of money calculations, we always calculate what is the value of 100 here. So 1 year period backwards we do. So similarly, what is the value of from the 6th to infinity, we will calculate the value of 6th to infinity back to 5th period, right? So when we calculate this terminal value is at the end of 5th year. Again, this terminal value has to be taken forward to the 0th period, because we are taking the decision today, that is 0th period. So now this is how the bigger picture looks like. Okay. So this we have seen in different format. I'm just trying to give you, okay, one timeline. It should be easy for you to comprehend that what we are actually doing. So there are some critical questions we actually dealt and discussed also. What much period should be taken for forecasting, whether it should be 3 years, or should it be 5 years, or should it be 10 years? That is the first set of questions regarding the forecasting period. There are some set of questions from 6th period that, okay, should I consider 6th period with certain growth rate, whether that growth rate will be equal to forecasting period growth rate, right? Whether that growth rate will be different from that. Obviously, it should be different, but then it will be lower than what the forecasting period growth rate will be. So we'll see, we have some assumptions to be made here as well, right? So we'll be having, okay, G is constant here. Okay. And we also make assumption here that G is constant during this period. Okay. Or if you don't want to make assumption of constant, you have to forecast for some individually, how do you do it? But then there will be some assumption with respect to some growth. So calculation of the FCF forecasting period will require the assumption of some growth. If not, then you have to use the sales forecast. That is again doing the growth estimates for the sales. So sales growth also we can do. So you can do the FCF growth or sales growth estimates, and some of that has to be calculated or assumed to be constant. So there are certain issues, what we will do here, what we will do here. So there are assumptions which we will be making in this period. There will be assumptions which will be making in this period. In this period, when we calculate like this, then we have seen that the formula which comes from for the terminal value, the terminal value formula comes like this, that FCF6, right? That is the first period, right? After the forecasting period, divided by, if we assume that G to be constant, then we say that it will be WACC minus G. So that is your terminal value. And this thing will be again taken back to the beginning with again dividing this TV, this entire TV, that is FCF6 divided by WACC minus G. But now here, it's only one cash flow and there is no annuity case. So since there is no annuity case and only one value has to be taken in the beginning, so we will divide TV by 1 plus WACC raised to 5 now, because we know that the TV is at the end of 5th year. So now you can take the present value of this TV like this. Now, as far as the forecasting period calculation is concerned, we need to forecast this, and that is a different ball game altogether, which we are going to do through this example using the Excel sheet. So you can see that there are certain issues which will come up with, but then you use the trend analysis or any other method to come out with these assumptions and calculate the value of those, add those values, and you'll get the FCF, right? So, and then once you get the, I'm sorry, not the FCF, the value. And remember that this is the value of operations which we are calculating, right? So entire thing which we are doing is for the value of operations. So when we want to calculate the value of the firm, then we say that, okay, value of the firm is equal to value of the operations and value of the non-operating assets, right? This we have seen. So whatever we have done so far here, this part, that forecasting plus terminal value, right? All that will come back here only. So from there, we have to add some additional value from the non-operating assets, and then we'll get the value of the firm. Now, once we know this, we also know that value of the firm also is equal to market value of debt and market value of equity. So if this is the case, and we have calculated VOP and VNOP, and then we get VF. So once we get VF, we can reduce the market value of the debt from VF, and you can get MVE, market value of equity. So once you know the market value of equity divided by number of shares will give you the expected market price of the company. Of course, I mean, this is the entire picture which we are looking at, right? Now we have seen this entire thing in terms of the balance sheet picture. So I'm just going to draw that, and then we'll go back to the new topic. Okay, so we are saying that these are the assets and these are the liabilities. In that we are having debt, equity, and we are talking. I'm going to do that CA minus CL this side. So CL from here, liability side, is taken as negative here, and then we get the fixed assets here. So this time when the CL is deducted from the right hand side to the left hand side, we can call these as net assets. Net assets. So we can say that this is the net assets balance sheet, and this is what we'll be using to calculate this values from the. So now we know the background how we calculate the FCF value for which we need, for the value we need FCF, right? So FCF is required. So now we discussed, now we are coming to the numerator part of the equation. So what we are saying is, okay, value of the firm is equal to value of operations plus value of non-operations. Value of operations is nothing but FCF divided by 1 plus WACC raised to T, and T is equal to 1 to infinity, and then we'll add value of non-operations to it. Okay, now the question is that what FCF will take. So now from here we are going to talk about FCF, and we have done that calculation. Free cash flow is the cash flow which is available to both the stakeholders, assuming as if there is no debt, right? And that we calculated in terms of NOPAT minus net investment in operating capital. This was written as also NOPAT minus OC2, operating capital 1, OC1. Now we know what is operating capital, right? Operating capital is net fixed assets plus net operating working capital. Okay, so you can calculate that. So this we already know. Okay, so that will be plugged. But another formula which we derived other day from expansion of operating capital was the NOPAT. Now NOPAT is nothing but EBIT into 1 minus T, right? So NOPAT is nothing but EBIT into 1 minus T. Okay. So NOPAT, we said plus depreciation for the period minus capex and minus change in net operating working capital. So we have used this equation also to calculate FCF. So calculate FCF using this or this. So we are talking about this part, right? So we are talking about FCF calculation. Now when we calculate the FCF calculation, we use the NOPAT here, and we did either use this formula or this formula. Most of the time, since depreciation values are available, capex is available, easy to calculate, we will use the second formula to calculate that, because ultimately when you do the OCA, you are actually doing that part only. But anyways, either you use this formula or this formula, you will get this value for a particular year. Okay, so this FCF will be calculated for the past period also, and it will be used to calculate, to find out what is the trend, and from there we'll forecast. So the picture which we are looking at here, so we have just said that, okay, for which the FCF is required, calculation of value of operations, the FCF will be calculated using that formula. Now, once we calculate the FCF for the last 5 years, I can assume that FCF growth will remain same. You can look at this point. So, and then I can forecast FCFs directly. Alternatively, instead of forecasting the FCFs directly, I can forecast the sales and calculate growth rate of sales and use that entire equation to calculate FCF. So from the sales, I will calculate the FCF, not from past FCFs that I'll be doing. So I hope you understand the distinction made between these two. When you want to do the forecast, so when you look at the Excel sheet which was given to you, the forecasting period is given for sales, right, cost of goods sold, and all the items on the income statement and the balance sheets which are required to be forecasted. So based on the assumptions of the forecasting, the Excel sheet was actually talking about case number 2, that the sales forecast is generated. And from there, entire balance sheet and income statement will be prepared. And then you calculate the FCF. Alternatively, it is also possible, the first method, that you calculate FCFs for last 5 years, calculate the growth of FCF, and assume that growth will remain same for next 5 years and calculate the FCFs directly. So either you calculate FCF directly or forecast the sales growth and then all the items and then calculate FCF. Both methods are used, but the second method is more preferable because you are getting into details of each item of the income statement and balance sheet. Whereas FCF is a shortcut. We are directly saying that, okay, last year mein aisa hua hai, and then they say we're just going to assume. So it is a small deviation which you can actually use, rather not deviation, shortcut. So you can go ahead with that also. But I think for the project purpose, we will do this part, that we are forecasting the sales and then calculating the FCF for each period for the forecasted period, that is 5 years. And once 5 years is calculated, you will also make assumptions on the growth, whether it will remain the same growth after 5th year or not, and how to calculate that we'll see. And that J also can be used. And of course, we have not touched upon WSCC as of now. So we can see that the entire picture, which is looking like this now, the value of operations is equal to value of value of firm is equal to value of operations plus value of non-operations is this. We are talking about only the first term of the value of operations here. And on top of it, we are going to add value of non-operations, and we can actually solve the problem. So now I'm going to just show you the PPT which we last class saw, and where this actual concept was solved. So this is kind of a review which we are looking at. So I'll just share the PPT. Meanwhile, you can ask me if you have any questions over here. See, this is important. The moment there is a gap, we are likely to forget small things conceptually, and then it becomes kind of difficult when you want to apply it. Okay, if you remember, we had taken this example particularly, FCF 0. So FCF 0 is the beginning period, present FCF 0. Now remember, the thing which is given to us, which we discussed, depends upon when this FCF was calculated, right? Are you getting this point? So when we talked about the 0th period, so this is the 20 million. So since it is given that from the beginning what is the FCF, so we are not using the variation that forecasting period alag and termination value alag. Here directly we are talking as if it is entire cash flow is available. From here only entire is available. No breakup of timeline. But in our previous discussion, we broke the timeline into two parts: forecasting period and the terminal value period. So here that is not given. Here what is given is directly entire thing is forecasted period only. So entire thing is forecasted. So you can use this is as if terminal value we are calculating, as if we are calculating the terminal value. So we can actually use the formula, which is nothing but FCF divided by WSCC minus G, because it is a kind of a perpetuity case. The terminal value is nothing but perpetuity case. So we did that, and we calculated the value of operations. And then once the value of operations was calculated, right, this one. So we did that previously. So value of operations was calculated. Value of non-operating assets, we can see that that was given to us, that is 100. So we are actually doing this. Value of the firm is equal to value of the non-operations plus value of the operations. So value of the non-operations is 100 and value of the operations is 420. So it is going to be 520. And then we said that, okay, the same thing is nothing but the value of the firm is also can be calculated as market value of debt plus market value of equity. So since we already know what is VF, value of the firm, which we calculated here, so we know it is 520. So market value of debt, which is here 250, so 250. Then obviously we know what should be the market value of equity. So that's what we did. So we calculated this and it came out to be 270 million, right? So that's what we did. So once 270 was done, then we said that, okay, what is the difference between book value and market value? And then that came out to be 60 million. So this is the representation of the entire thing. So I assume that now entire picture is clear to you, and then we can go ahead with calculation of these things. We have seen all this. I'm just repeating so that we can come to the same level of understanding before we go ahead. And we also did this as a direct formula. You can use it. As I said that this is the profit margin. So market value added also can be calculated like this. So we have seen all these things, right? So this is fine. This we can do that. It's okay. I will be sharing some of those slides to you. Okay, so we have done this part. Any questions on any part? Because now we are going to go to next topic. So before we get to the next topic, I want you people to be very clear that whether you understood this or not. So let me spend some time here with you people, please. Can you participate? Tell me whether you have any kind of issues or any doubts on the discussion which we had, and also during for the project you can take it offline also, not an issue, but you can also ask if it is stopping your work. Yes.
Sir, related to the project itself,
Okay.
there were a couple of issues. First thing, the cost of goods sold that we are calculating in the income statement. In the balance sheet, we were getting change in inventories and there was no purchase mentioned. So should we be considering change of inventories as the cost of goods? Because then I had a negative change of inventory too.
No, cost of goods will be calculated and it has to be done, and it will be available in the schedules. So see, what is the formula for cost of goods sold?
Yeah, open plus purchase minus closing.
Yeah. So if you remember, 1 minute, share the. Okay. So what we are saying is, okay. So when you have the beginning inventory, suppose this is the beginning period. So let me do it like this only. So what happens is your beginning inventory is here, right? Beginning inventory. And suppose you don't do anything, no sales and no purchase. So obviously that will be remaining the same because nothing is sold nothing is purchased. So beginning inventory, if it is 100, it will remain 100 at the end of the period. Right? Now, what happens if I purchase something during the period? So the beginning inventory plus I purchase something and I don't sell anything, that will be my ending inventory. Right? Now, the third case is that if I have the beginning inventory, I purchase something which will be added, I will be selling something which will be deducted. That selling is now cost of goods sold, because sales are the figures which are with the profit margin. And now you can see that that is my ending inventory. Right. So cost of goods sold is basically saying the difference between these two. So you can see that beginning inventory plus purchase, right? Right? Minus cost of goods sold. Right? That is what you are doing. You had some 100 units, you purchased some 50 units, 150. So you add 100, you purchase 50, and you sold out of this 70 units. So what is going to be my ending inventory? So ending inventory is going to be 150 minus 70. That is 80. Correct? So now we know that ending inventory is 50. So using this formula, we can actually calculate now the cost of goods sold formula from here. So what is cost of goods sold? So cost of goods sold is equal to, so I can take this term to the right hand side and this will become minus. So beginning inventory minus ending inventory plus purchase. Right. So if I do only this part, I'll be missing the purchase part, right, from the equation. So cost of goods sold is not only the change in the inventory. It also has to consider the purchase during the period. Okay, this particularly happens if it is a manufacturing set when the products are which are countable, and you can actually count those goods and all that, and all that can happen. So this becomes complex when there is a service industry, and then instead of cost of goods sold, we'll call that as cost of sales or cost of service. So, but the idea remains the same. So what we are saying is that we cannot simply take this, but we have to see what is there in the schedules of the statement. So any questions on is this clear now?
Yes, sir, this is clear, but I think purchase directly is not mentioned because in the schedule.
No, so that will not be there in the balance sheet. I mean, in the income statement, or neither it will be available in the balance sheet. So you have to go to the schedules to find out how the ending inventory was calculated. So if you know the,
understood, sir.
So then it will come. But anyway, for your purpose of project, when the cost of goods sold is available in the income statement, right? So you'll be having sales and cost of goods sold is given to you. You don't need to worry about how much is the purchase and all that. You can actually, in fact, use this equation to calculate how much should have been the purchase. Okay. So once COGS is known.
So actually, they don't follow this.
What is that?
So they, even my annual reports, they have not followed this format. Sales minus COGS will give you gross profit. That is not followed.
No, they will not say directly because they maintain purchase account separately.
So yes, so since mine is a company, car manufacturer, I already have purchases, but Himanshu does not have.
Correct. So you will go to the schedules, you will find it. It cannot be because this will not change. It will be there. You go to
so I think the
yes.
Yeah, the other method you were saying, no, that reverse calculation, I could try that too. I mean, adding up depreciation and other expenses and deriving the cost of goods sold.
Correct. But then what purpose you need that? Because once we know the cost of goods sold for the last 5 years, we are using the same thing to forecast for the next 5 years. Right. So the derivation of cost of goods sold is for the study purpose, like whether we can really understand how they are doing it, for which we need the schedules, because each company will be having their own structure will be same, but then they will be having some different way to maintain it. So we need to look at how they are actually doing it, because this equation will not change. This is conceptually beginning inventory plus purchase minus ending inventory will give you cost of goods sold, or that's what we conceptually said, right? So there cannot be anything else in between. Yes.
Sir, in my balance sheet, there's income statement is given at cost of material consumed. So can we consider it as a purchases?
Correct. Cost of materials also you can go. So you have to just check whether they are mentioning cost of goods separately and cost of materials separately. Because see, when you talk about the beginning inventory, so each one will be bifurcated into small parts, right? So you can see that beginning inventory there will be some parts, then components and all that. So you can see that they will call this as stock. Okay, so when they call their beginning stock, ending stock, so instead of calculating the word using the word inventory, they will be using the word stock. So beginning stock plus purchase minus ending stock is equal to cost of goods sold is what the wording will be used. So in this case, if the stock is given for each different material, then you can get into detail of that also. So it depends upon how much you want to get into detail, not a big issue. If you want to go say that, okay, which components actually are causing the cost of goods sold to go up or and down, and therefore accordingly the forecast will change. Remember, I mean, that's what I'm saying. If you do these kind of things to forecast, your forecast will be more detailed than others and you will be having more confidence, because when you say that, okay, which component is actually causing the cost of goods sold to go up and down. So you can go into details. No
Excuse me,
issues.
sir.
Yeah.
Sir, in my income statement, it is given that cost of material consumed separately, purchase of stock in trade separately, and change in inventory of finished goods and work in progress separately.
Yes. So use this to calculate the cost of goods sold.
Means opening plus cost of material consumed plus purchases of stock in trade plus change in inventory minus closing.
Yes, I mean the same thing which we are saying. Whatever beginning inventory we are having, cost of purchase, right? Cost of materials. That is, cost of materials will be purchased in your case, because if they are given you the stock separately and ending inventory stock separately, you can calculate cost of goods sold. So you can just add up those. So your cost of goods sold will be beginning inventory minus ending inventory plus purchase. That is cost of material. So in your case, I'm just writing it for a specific case which Himanshu is talking about, not Himanshu, Nikhil is talking about. That if I'm having beginning inventory, ending inventory, and instead of purchase, they are saying cost of materials. So you can see that it is cost of COM in that case. Okay, so the terminology will change, but the idea is that it is a purchase. Is that clear? Nikhil? Hello, can you hear me?
Yes, sir,
Yes,
we
sir.
can hear you.
No, okay. All right. So is that clear?
Yes, sir.
Okay. So please go through that, because see, the project will throw a lot of challenges. It's going to be, because you will find that each balance sheet will be mentioned differently and maintained differently. But what ultimately you will find is that the structure remains the same, and you have to find out the details of each item in the schedules which are maintained and given as an attachment, and they are part of the company reports, annual reports. So you can see that. So you have to download those company reports, and you will see that what actually they are mentioning, and you will see a lot of interesting information in those company reports also, because each company is having, and that's how the manipulation happens, because what they do inside, just looking at the balance sheet and income statement, it becomes so difficult. And you will see how even like inventory is maintained. So we are going to talk about the straight line method versus the reducing value method. So what happens is, in the reducing value, uh, when we are talking about, it goes with like this. Okay, and in the straight line method, it is simply same amount is deducted every year, whereas in this case different amount is deducted in the beginning more. So these are the accounting practices. This is the tax practices. In the tax, they'll be doing some different calculations, and for the maintenance and showing it to the company people, I mean the stakeholders, they will be giving this. So that raises many questions, and we will see some of them, that how to deal with this. And we can see that the other day we will say that the deferred taxes. Okay, so the deferred taxes entry, we will see the deferred taxes is coming because of this change in depreciation practices. Okay, anyway, I think we will see a lot of that. We'll not be able to cover the entire thing in what do you call the class sessions. We have to do a lot of outside discussions as well, and we'll take it forward. But I think keep floating these questions. If not possible to deliver the entire, I mean, deal with all the problems which are there, we can take it outside, but please note it down somewhere so that we can discuss that. We don't miss it out. Okay. Okay, so now we will go ahead. So we had the discussion saying that the FCF can be calculated like that, and now we want to go ahead and see that okay, that we know value to be calculated, value of the firm. Can I change the part which is going to be now interesting, and let's see how that actually develops. So I'm just going to write that value of operations is FCF. So you will see that I'll write this another 100 times, so don't get bored. And this is going to be T, right? T is from 1 to infinity. So this is the simplest form. We can break it into two parts, but then I'm just writing it for this illustration purpose. So we are saying that okay, this is the thing which we will require, and plus value of non-operations which can be added to it. Okay, now the questions which we are going to deal with it are first with the numerator. I'll tell you what it is. So we are going to talk about FCF first. So in the FCF part, we are having two cases. One is that free cash flow I'll calculate to both the shareholders and stakeholders, which will be called as firm, FCFF. And in fact, whatever formula we wrote was for FCFF only, right? So the initial calculation, this part, when we calculate the NOPAT minus net investment into operating capital was FCFF. Okay, so let me write it. FCFF is nothing but NOPAT minus net investment in operating capital. This can also be written as NOPAT plus depreciation minus capex minus change in net working capital. Okay, the other part was the FCFE. So instead of calculating the cash flow to the firm, I'm just saying that cash flow to the equity shareholders. Okay, now we'll see how to calculate that also. Obviously, if we are calculating EBIT here, it will go to the net income here. So we'll see the derivation of the formula here, and we will do that also. So from FCFF also we can go to FCFE and vice versa. Now, as of now, the questions are important that we said that FCF will be calculated in these two fashions, two ways. But what happens to this WSEC? So here, when we calculate it like this, since it is for entire firm, we are going to divide it by 1 plus WSEC, right? But when it comes to here in FCFE, it's only the cash flow available to the equity shareholders. So we should discount it only with the cost of equity, right? So here the cost of equity need to be calculated. So now if you see the entire picture, we are doing this FCF in two ways. One is FCFF, FCFE. If I use FCFF in the numerator, then I should divide it by 1 plus WSEC, right? Once I do this, then I'll be getting FCFE, that is value of the equity only, I mean value of the firm. But if I use this, I'll be getting value of equity, right? Not value of operations. So I cannot use this formula here. So once I calculate value of equity, right? So we have to add value of debt to it, right? And that will give directly the value of the firm. So there is no question of value of non-operating there. So you have to remember this part, but then we'll do the calculations later, right? So now we look at it, the structure wise, we are saying that FCF can be calculated in terms of FCFF and FCFE. If I am calculating FCFF, I am dividing it by WSEC. If I am calculating FCFE, I'll be dividing it by KE. Now you know what is cost of equity, right? What is cost of equity? So you can actually calculate cost of equity using the dividend discount model, which we studied in the previous course, right? We can use the dividend discount model, right? You know that, or you can use the CAPM, calculate that. So dividend discount model will talk about the cost of equity. So KE is equal to the dividend which is given divided by R minus G. The same thing which we are doing for the perpetuity case, or here in this case we'll look at this will be equal to RF plus beta I into RM minus RF. This we know, this we have done earlier in this case. So we have at least two methods to calculate this, the KE. WCC, we already know how to calculate WCC, weighted average cost of capital, and you see that how the WCC will be calculated. So WCC will be equal to the portion of debt divided by the portion of debt plus equity, right? Multiplied by cost of debt plus value of equity divided by the portion on the value of debt plus equity multiplied by cost of equity. So you know that KE can be taken from here, right? The KE can come from here. KD will be calculated or it will be available from the income statement or balance sheet. So there are different methods to calculate KD. So once we know this, we will also use some calculations for this, but then this is in the module 3. So I'm just giving a backdrop. So we are going towards that now. So we'll be, after finishing the adjusted present value, we are going to go to cost WCC and how that actually changes. So we are saying that although this is simplest equation, we are questioning how the FCF will be calculated. We are going to question why WCC will be calculated like that and all sorts of things, right? So WCC, change in WCC will throw some more challenges. So remember what we are saying in this formula, that WCC will remain same for throughout the period. What happens if WCC changes during the period? And all that will be considered to calculate different values. And that's how it becomes now a little bit complex now. So I'm just giving a background. So I hope you are understanding whatever is written on this slide particularly. Is there any question? Is there any question here? Are you understanding how we are going through?
Yes, sir.
Is this clear? I'm saying the structure. Don't look at the calculation. We'll do the calculation each one. For each one, we have to do the case study. To understand conceptually what is being done. So we are saying that FCF can be calculated two ways, right? If FCF is FCFF using this formula, then we have to divide it by WCC if WCC is given to you. So this will be simplest part, but WCC need to be again calculated, then you can use this formula. Similarly, if we calculate FCFE, then you will get the value of the equity. And in that case, you have to divide it by cost of equity, and cost of equity can be calculated in turn like this. And you can see that you have assumptions on the beta also, whether beta changes and not, and all that. So lots of things which are there based on many assumptions in each one of them, right? So you'll see that whatever we calculate is actually challengeable. So anybody can challenge you. Yes.
Sir, I had one question. I mean, yesterday in the article that you sent us, there was this concept where employees are using their stock options.
Correct.
So, I mean, in that case, so I mean, in what part exactly will that affect in value of equity or like the
See, the employee stock option, it depends upon, it's a derivative kind of instrument, right? So
Yeah,
what
right,
happens is, so it's a contingency claim. So if we find that if that is going to be added, I mean, if the price goes up and then we know the time period, then accordingly, according to the time period, we can consider the value impact of that on the share purchase. That can be done, right? So that is contingent. So the contingent part are outside the balance sheet, but you should look at always what is there in the contingent liabilities, because that also is concerned. This is also one of the important parts. So for example, there are lease contracts, right? We take the interest part of the lease here. Similarly, we'll see that in the case of employee stock option, when it is mentioned, if there is a payment going out to be because of that, right? So that need to be considered also. So it cannot go out without considering that. But then if it is probabilistic in nature, that when the people will use it, if know the option expiry date, that when they will purchase, then absolutely no issues. Then you can see that the option is expiring this period, and therefore this will be the change in the number of shares there, and therefore this will be the change in that. So that you can consider as a one-time phenomenon. Now, whether that will be repeated in future or not, so we have to consider that possibility for forecasting the FCFF or FCFE. Remember, all this is one-time phenomena, cannot be considered for the regular phenomena. So the generalization which we talk about in statistics, right? So So you cannot say that one event will be generalized. No, we have to see that whether this event can be generalized. So is that happening regularly? So FCF1, FCF2, if we see that there is a trend, then we can. Similarly, for the stock options, whether it is a regular phenomena of the balance sheet and income statement, then you must consider it, because that is what the companies are doing continuously. So you should consider.
So, I guess in the article it was mentioned that the company gets tax benefits if the employees use the stock options.
Correct.
So the tax
Yes.
part will be affecting the
Yes.
value of operating this thing,
Yes.
right?
Yes. See, the tax part on that is for the hands of the people who are doing it. But then for the company, tax part is in the here.
Yeah. Okay. Yeah. Exactly.
Okay. So if EBITs are getting affected, only you are concerned. That tax which they are getting it benefited is only to the extent of this. Okay.
But then
So
if that increases, then it will change the overall
so
calculation.
you should ask this question, because of employee stock option, whether my EBIT is changing.
Yeah, because then it was mentioned that the operating capital because of that has increased threefold.
Correct. So, but then you have to calculate that is a regular phenomenon, not regular phenomena or not,
Okay.
or is
Okay.
that an odd event? If it is a regular phenomena, you should consider that as for the part of generalization for forecasting, and then you must consider it.
Okay.
So that
Understood.
is what I'm saying. See, important part is that, and I think this is what we should discuss. Okay. So if you look at here, actually now I'll write the question here also. So you can see that here it will be net income, right? So instead of EBIT, net income, and then it will be interest into 1 minus t. So that will come. So we'll see that interest multiplied by 1 minus t is what it will come here, plus depreciation minus capex minus change in net working capital plus share issues plus retirement of the issue of new shares and all that. So that is a big formula. So I'm not dealing with this right now, but I'm saying that whatever doubts we are having, please debate on it and see that whether it is affecting my formulas, whatever my assumptions are there. If it is assumption, you must consider. Second question you should ask whether it is affecting one time or it is a regular phenomena. If it is a regular phenomena, we can consider it as a generalization. That is, if it is regular, it's a generalization. So you can consider it as that as impacting factor for the future also. And therefore, it will change the value of the form. Okay, is that clear?
Yes, sir, it is clear.
Okay, all right. So now, where was I? So we were talking about. Okay, so the two parts, FCFF and FCFE, and then we said that WSCC, which we are considering, can also be questionable, and then if there is a varying WCC, what is to be done? So one of the ways by which we can say that, okay, this part, which is WCC, the part which we are talking here, so I'm just going to do like this. So this part can be considered and broken down in a way that, okay, if I say that if this FCFF, right, which we calculated using this NOPAT minus net investment in operating capital, if I divide it by, not by the WCC, but I'm just going to write something like this, 1 plus WCC 0. I'll explain what does that mean. And then remaining, because of the side benefits like tax benefits and other, so other benefits because of date and other, all that, right? So if I bifurcate this, so FCFF divided by WCC will give the answer which is not lesser than this, but then I will add and divide this by 1 plus cost of date, which is WCC including both. So there is a difference between WCC 0 and WCC which is normal WCC. Right. So here actually we'll see that it will be only cost of date, because only if date is taken, if I take. So this bifurcation is coming from the idea that if my capital structure considers date equity or that is my first case. And second case, I'm going to say that my capital structure is only equity, there is no debt, right? So if this is the case, this is my second case. So what happens is, this is where it is considered. So it's saying that if my all equity cash flow is there, my cost of all equity will be denoted by WCC 0, and remaining part, because of date, if I add date now, so from this position to this position, if I add date, because of date, what is the benefit I'm going to get? This concept was dealt in the capital structure theories. Remember, that is a part of capital structure. If I change the capital structure, what happens? So this part, which is all equity, no debt. No debt, what is my value? With date, what is my addition to the value? And that's how the FCFF, which is here, is done. And this concept of bifurcating is called adjusted present value. And that is what we'll be seeing in the what do you call in this module APV, and that is shown in the syllabus also in the part of module 2. So sometimes I take this after WCC because you need to know what WCC, but I'm just giving the background, and then we can go ahead with the conceptual clarity. There will be a lot of things. Now you can see that the simplest thing which we started off with has become so complex now. See, you can see it here. So we started looking at FCF, then we said, okay, we'll break it into many parts. Then once we break, again, I'm giving a different meaning to the same formula, saying that if I'm dividing the entire amount by WCC, but then I can divide it into 2 parts and all that. So these are the variations of the same thing. So the basic structure doesn't change. Now capital structure, how the capital structure affects this, for which we have to see the other part which I'm going to show you. So basically this thing which I'm going to show you, can you see the PPT?
Yes, sir.
Yeah.
Yes, sir.
Yeah. So now, since we are almost closing the time, but tomorrow we'll take into detail. But just remember that the capital structure is talking about 2 parts. One is that with tax environment and without the tax environment. So we already know this from your previous course, which is the corporate finance. So we have seen this capital structure things, right? And we have seen that MM theory. In the MM theory, when what he said with the taxes and no taxes. So if you see, so we'll do that in detail tomorrow, but I'm just showing you because the conceptually will be connected. I don't remember whether I shared this with you in previous course, but then there. Okay, so no tax environment, value of levered, this is levered. So if you have taken the date, if you take the date and we don't have the date, no date, that is unlevered. So U is for unlevered. So you don't take any leverage. So if there are no taxes, there is no difference between values. Right? That's what he was saying. So capital structure is irrelevant. Capital structure is irrelevant when there are no taxes. And now if you go, because of that, what happens? The cost of equity when you take the date will increase by base cost plus, because of date, what is the cost? So I'll explain that tomorrow, but then I'm saying that base cost plus the addition cost because of the date. Okay, now if you see this part is what we have seen in previous one, right? So this is your R0, the base cost, right? And then we are saying that cost of equity increases as the date increases in the companies. And this we saw that with the no taxes. So value of levered from is equal to value of unlevered from when there are no taxes. But we are not talking about no taxes part. So in the case of taxes part, we are getting this. So value of levered and value. So this is what we are actually using in the adjusted present value method. So what we are saying is, if company takes the date and if there is no date value, so the value when there is no date plus the adjustment to the leverage part. And that is what I was showing you in the previous explanation. And this is what we'll see that how that changes. I'll show you the diagram and then we'll close for today. And now you can see here, because we have taken the date and the tax part which has worked, it has reduced my RS, my equity. To that extent, the cost is decreased. But at the same time, you can see that earlier this was the line when there were no tax. But because of tax, the total will go down. But it is not straight line. So it is not a straight line. It is a curving line. So you will see that after some time it might go up. And these are called cost of distress, cost of when the company goes into liquidation. So these are the things which are there. So we are saying that the WCC will change during the period. So these assumptions will be incorporated into our discussion of adjusted present value, FCFF and all that. So various methods are there to calculate the value. We will come to that. Practically you have to do it in your case of company and do all this. So we are going to use all the equations which are here and you should be able to answer them. So be prepared. So tomorrow I'm going to show you how the calculations. In fact, I wanted to show this to you. Can you see the Excel sheet?
Yes, sir.
Yes, sir.
So this calculation using this capital structure theory, you can see that it is a capital structure theory, and this is the illustration like how actually it affects or not affects on the WCC. So you can see that RWCC 0, and then RWCC with the taxes what happens, without the taxes, with the date what happens, without the date what happens, and all that will be shown here. Okay, and this is just to ensure that you understand, and then this is proven. So whatever is the theory is there, that is shown as a proof using these calculations. So that we'll see tomorrow. So I hope all of us are on the same page where we stand, what we are discussing. Okay, don't forget this basic structure which we are going to deal in the background. Okay, all right. So the attendance, please. So today is 12th session. So Aniket.
Present, sir.
Rohan. Okay. Devnita is there. Shubham.
Yes, sir.
Vaishnavi.
Yes, sir.
Pradeep.
Present, sir.
Akshay.
Present, sir.
Maitri.
Present, sir.
Nupur. Nupur. Okay. Neha.
Present, sir.
Prabhat.
Yes, sir.
Pravalika.
Present, sir.
Prathamesh.
Present, sir.
Okay. Okay, see you in FD class. Bye for now.